Good morning, everyone. Welcome to our seminar on using metrics to drive your business growth webinar. This is a part of a series of seminars that we're putting on for the Queensland Small Business Week, which is a Queensland government initiative, which they're promoting the vital contribution of small business makes to the Queensland economy. So as part of that, we've developed a series of seminars that we've been holding over the last day or so, and another one tomorrow and today's session. So we've done a seminar on one-page business plan yesterday, and building on that, today's seminar, we're looking at the metrics that drive your business. Tomorrow we're also looking at we're holding a breakfast seminar, which is examining the difference between cash flow and profit in your business, and how you can manage the cash flow a bit better. So first of all, I'll introduce myself. My name's James Morris. I'm the Director of Accounting here at Medorus. At Medorus here, we're a combined financial planning, wealth, superannuation, and accounting and taxation practice. And our objective is to help you with financial performance solutions that suit every facet of your financial life. Bit of an introduction into me as well. I'm a chartered accountant, studied at Queensland University Technology and the Australian National Uni. I'm married, 2 kids. They're 2 of my grandkids. I've got 3 grandkids in total. Collingwood supporter. Sorry if I've upset a few people there. Support the Broncos, and I enjoy a good science fiction novel. As with all good seminars, we need to include a general advice warning. This seminar is giving out general advice. It's not meant to be specific for your specific circumstances, and happy to take the discussion further with you personally about something specific for your business. But essentially what we're talking about today are some general concepts. So let's put some context about what we're talking about and why we want to drive our business. These are some of the stats just recently out from the Bureau of Statistics. There's 2.2 odd million trading businesses in Australia, and about 2 million of those have a turnover under $2 million. We'll talk a little bit about the definition of a small business in a minute, but according to the Bureau of Stats, 60% of these small businesses will cease operating in the first 3 years from starting. 44% suffer from poor strategic management, 40% inadequate cash flow or high cash use, and 33% suffered from trading losses. One of the key things that these stats tell me is that a lot of businesses out there are failing to plan their business, failing to look at those fundamental things that run their business. They don't have any mechanisms for identifying when there's cash flow problems coming. They don't have any mechanisms in place to identify whether they're making money or losing money. And so, again, part of what we're doing today is to just give some basic education on, well, what are the sort of things that we should be looking at in our business to help us manage those. Basically, we started yesterday with the one-page business plan, and it follows on from the concept of strategic planning. If we don't have a plan, and again, a plan is not just an idea, it's a roadmap. It's a map that takes you where you want to go. If you look at going on a road trip, you don't set out on a road trip with no destination, no idea where you are, and just going on a trip. It's not going to succeed. So you need to plan to succeed, and part of planning to succeed is to know where you want to go, and then we can design some metrics. And when I use the term metrics, I like to use the word yardstick. So they're a measure of, am I on the road or am I not on the road? Am I heading to my destination, or have I gone off track somewhere, and I'm not. So there's signposts, yardsticks, metrics, all those sort of terms are interchangeable. So, basic concept, failing to plan is planning to fail. So that's what the stats are telling us. And essentially, most small business, and again, we'll have a look. Well, actually, we'll have a look at the definition of a small business now, because it has changed. I mean, a small business is defined as a business with under 200 employees. Well, that's a fairly significant business. So we've ended up developing some other terms called a micro business, which employs 1 to 4 employees, and small businesses, which employ 5 to 19 businesses. And then we have this medium businesses, which is 20 employees to 200 employees. So the concepts that we're talking about today, I might use some numbers that might be relevant to a medium business, but the concepts that we're driving apply to all of those businesses, whether you're a 1 to 4 employee, or whether you're 5 to 19, or whether you don't have any employees. The concept apply to the business as a whole. So whether you're micro, small, medium, if you're not planning, if you don't have a plan, then there's a good chance that you might fall into those unfortunate statistics that we looked at just previously. As well as planning, we need to understand our business climate. And essentially, this is just trying to set the scene of why it's so important to have a plan and to have a good understanding of your business. I mean, business is getting harder. There is more competition. There's significant changes happening within marketplace, whether it's online shopping, whether it's the Uber impact, for example, if you're in the taxi industry, but also Uber's, Airbnb, restaurant, Uber food deliveries, those sort of things, they're all impacting and changing our marketplace. Just the social media concept, all of those sort of things are impacting on the way we do business. We've also got some significant emerging markets happening within the world. China, India, the US is starting to get back onto its straps, and we've got to start to understand that the world is getting smaller. So, we're, and one of the things that have impacted over the past 10 odd years is how easy it is to get something manufactured in China and bring it over here in Australia. And so if you're in the manufacturing game, you're effectively competing against very low labor costs over in China. And with the world getting smaller, the transportation and movement costs, freight costs are getting smaller, that sort of thing. So it becomes very harder to compete. In our business environment here in Australia, we've got, there's always labor issues. It's employing people, workplace health and safety, a lot of considerations there, quality of goods, delivery, rework, all of these things impact on your business. And so a lot of the external forces you might not be able to control, but what you can control is the internals and your preparedness to react to some of these pressures that are hitting your business. So one of the themes that I would like that you take away from this seminar is that you need to work more on your business and less in your business. So some of the concepts we're talking about today need to be looked at regularly, whether it's a weekly meeting, a fortnightly meeting, whatever it might be. You need to constantly be working on your business and looking for ways to improve the business. And we'll talk about a little bit later when we start to look at the two key driving economic forces within your business, how you can manipulate those by sitting down and having whether it's a marketing plan or a efficiency within your business, your processes, or whatever it might be, that we look to tweak those two primary drivers to improve your bottom line. Okay, so we're going to have a look at some very fundamentals here when it comes to looking at financial statements. And again, as I said, this is very simple, and I've designed it that way so that we basically can cover everyone. You know, if you're from a $20 million business, this might look a little bit simple, but it's basically designed to cover all bases. So let's look at a simple profit and loss account, which most people probably don't look at often enough. But it's basically one of the primary reports that come out of either your accounting software, whether you're using Xero or MYOB or something like that, or whether it's provided by your accountant. It's something that you should be looking at often, bare minimum monthly, and in some cases, larger businesses will be looking at it weekly, but certainly annually is, you know, one of the very frustrating things in my game is when I talk to someone who brings their information in, you know, 6 months after the end of the financial year and asks me how I went last year. And I sort of think, well, that's a problem. You need to be thinking about, you already should know. You should know how you're going for the first half of the next year, and you should know what you're going to do for the next half year. So that's all part of the planning process. So when we look at this report, it's pretty straightforward. Income, this is simply the income or the invoices that you've received for the period from doing whatever it is that you're doing. So whether it's sale of product, whether it's provision of a service, whatever it might be, whether it's retail, wholesale, this is essentially your total income from your service that you provided. One of the key things that I'll mention here is that line is pretty much unlimited. You can push your sales, you know, subject to some constraints, which is, you know, probably more working capital, ability to service, that sort of thing. But essentially, when we talk about growing your business, this is the line that is effectively somewhat unlimited. But it does come across one of the fundamental laws in business, which is growth sucks cash. So if we want to increase our sales to a much higher level, we've got to understand that has some impact on our cash flow, has impact on our working capital, has impact on our stock levels and that sort of thing, which again is another area for another seminar. But it's important to understand that that's one of the lines that we look to grow. When we look to cost of sales, I try and keep this relatively simple. So if I'm selling widgets, that's cost to buy my widget. If I'm manufacturing a widget, that's the materials that I've used to make that widget. We can be very detailed in what we put in cost of goods sold. You know, when we went through uni, you know, we learned all about absorption costing and all these sort of things where we allocated direct and indirect costs, indirect labor, direct labor, in amongst all of the cost of sales. But for the keep it simple process, I like to just say, well, okay, let's just keep it at the materials or the cost to buy whatever it is that I'm selling. So that when we look at the gross profit, which is essentially your sales less the cost of your sale, it's essentially the reward for doing whatever it is that you've done, and it has to cover all the costs. So when we look at labor, sometimes labor is a bit of a fixed cost. People tend to try and put that into the cost of sales as a direct cost of manufacturing or something like that. But a lot of those costs are actually fixed. In other words, you know, employees have a fixed salary, so you can't necessarily change them. They don't necessarily change with the way your level of sales changes. Whereas, for example, the cost of your materials goes up and down depending on how many you produce or you don't produce. The cost of buying a widget increases as your sales increase. So when we come down, so gross profit is what drives your business, and I think it's probably one of the most important numbers that businesses need to focus on. And again, when we talk about motivation, I've often seen sales force, your sales force being remunerated or being incentivized by sales. But the problem with sales is it's not necessarily generating gross profit. So if if your salesmen give away discounts, give away percentage, then it's going to eat into your gross profit, which potentially can be counteractive. So motivation or the best incentive programs around will focus on gross profit. So in other words, increase your sales, but we want them at this margin. We need to get this sort of margin out of them. Then we look at overheads. Overheads, one of the things I will say with overheads is they have a bit of a bad rap. Overheads, expenses, whatever you like to call them. I'd like to change the dynamics there a little bit and call them your resources. So these are the things that you spend your money on that drive your business. Without those resources, the sales don't happen. The goods don't get made. The goods don't get sold or delivered or whatever it might be. But essentially, they're your resources to make your business run. And by all means, the resources have to be well used. They have to be looked after. You don't just waste your resources, you manage them well. So that you still got to have resources to make your business run. So it's limited about how much you can cut these resources down. So if you cut them down to nothing, your business will starve and die. So you need to feed the business operation, and that's what these resources are. And then so your operating profit or your gross profit there is to cover your overheads, and at the end of the day, hopefully produce a net profit, which that net profit gets reinvested, hopefully back into your business, or paid out to the stakeholders as dividends, or pays off debts, or rolls into your balance sheet. Now, just to get the connection between the other report that you generally get from your financial statements is your balance sheet. I'm not going to spend a lot of time here, but just talk about a couple of issues or a couple of things to understand. Essentially, your balance sheet is telling you what assets I have and how I funded those assets. And assets essentially are things like your plant and equipment, your cash at bank, or but your trade debtors, your accounts payable, your stock. It's your working capital is part of your assets. Now, your working capital can actually include some debt. So in other words, your suppliers, people that you owe money to, form part of your working capital. So all of those assets are funded either by the owner putting their own money in, or liabilities such as bank loans. So that's the equation that we're looking at. So when we talked about the net profit before, if the owner doesn't need to reinvest them into some assets, be that more stock, or he's giving more credit out to his customers, or he wants to keep more money in the bank, it comes out the other side as dividends. So there's a whole lot of metrics and ratios that are happening in the balance sheet, but it's not the ones that we're going to be focusing on today. We're essentially looking at the profit and loss account. So what I've done here is just put together a simple P&L, added some numbers to it to give us some concepts about what we're looking at. So here we've got a business turning over $1 million. It could be, as I said before, it could be anything. It could be selling, it could be making, but essentially, in order to produce that $1 million worth of sales, it's had to either buy materials of $600,000 or buy widgets to resell for $600,000, and they've produced a gross profit of $400,000. We've got some overheads or some resources there that have gone into producing that $1 million worth of sales, and essentially we've come down to a $100,000 net profit. Now, when we come back and look at the gross profit, we're effectively, sums are nice and easy. We've got a gross profit margin there of 40%. The the question that we sort of need to look at now is what can we learn from this? And essentially, for every dollar, we're effectively spending 60 cents on some form of material or good, and we've got 40 cents left over to cover our overheads and the other things within our business. Now, one of the simple mechanisms that we get from this information is to look at a break-even point. Now, while the break-even point is not what I want to cover today, but it's just an easy measure to look at this particular point. So a break-even point is saying, well, at what point do I cover all my overheads? So again, it's just your fixed costs or your resources divided by your gross profit percentage. So in this particular case, where we're looking at a $400,000 gross profit, or should I say $300,000 worth of overheads at 40% gross profit margin, we have to do at least $750,000 worth of sales in order just to keep the doors open. Now, it's a little bit more complicated than that, because obviously in that simple example there, we haven't accounted for, we might have some debt we're paying off, so we're going to need some cash for that. We're going to maybe have to buy some new equipment, so we're going to need some cash for that. So that fixed cost may well, you should probably expand that to be fixed costs plus loan repayments plus my projected capital expenditure. And so in order to cover those things, it might be more like an 800,000, 900,000 level of sales that you need to achieve. But again, that's coming out of your, for example, your one-page business plan. It's coming out of that strategic planning that you've been through to determine, well, where am I going? What are my requirements? And these are some of the things that can help you assess where you need to be. So let's look at this. This is where we need to start now breaking down to what I consider the fundamental economic engine that drives any business. So using that same example that we had, let's say he sells widgets. He sold 4,000 widgets. So divide 4,000 into $1 million. He's got an average sale price of $250. Now, it might be that when his salesman goes out, his salesman can negotiate as to whether he sells a widget at $300 or $200. It might not be a fixed price at $250. It could, but essentially that's the average that has been sold. And that's one of the concepts that you need to get a handle on here, particularly if you're in an industry where pricing is negotiated, that you're looking for an average. Overall, you want to get an average, well, in this case, $250. There'll be some wins and there'll be some losses, but you've got to make sure that the losses aren't dragging down that average sale price. And again, we've got 4,000 widgets, so we're actually generating $100 per widgets in average gross profit. And again, it might be that we're talking about an average. We're not talking about a fixed number. And so, for example, in a business that might have 1,000 different lines, we're still talking about average sale price, average gross profit. So for example, a bakery might have a dozen different lines of goods that they sell. Overall, there will be an average sale price per customer. There will be an average gross profit that they make out of their sale of product. And we'll talk a little bit later about whether we drill down into every item or whether we stay up and just look at a global figure. And again, that depends on your reporting systems, what information that you have available to actually assess what's going on. All right, so actually just one of the most common areas where you'll see average gross profit being looked to be maximized is when you roll up to the favorite takeaway food restaurant and they say, would you like fries with that? So what they're actually doing there is trying to sell you some fries which have a very, very low gross profit margin. What I mean by that, sorry, a very low cost of goods. So they have a very high gross profit margin. So if they can sell you fries, they've just lifted the average gross profit of the sale that they're just making. And it hasn't, and one of the positive things there is that cost them nothing in overheads. They still had the premises there, they still had the sales lady there, they've still got the kids out the back cooking. But if they are able to increase their average gross profit by selling you some fries, they've just improved the bottom line because their resources didn't change, but they've got more gross profit, and that flows straight to the bottom line. Things like, you'll also see it in areas like, for example, I don't know how many times I've put my car in for a service and I get a call from the lady who took the booking, and she says, oh, look, you're due to have your injectors flushed or something, my indicator fluid changed or whatever it might be. And so that's just looking to add something little extra, for a cost of $100, we can flush your injectors. And so they're just looking for that simple little thing that'll lift the average gross profit. Extended warranties are another area. Insurance, particularly. And, so it's just looking for that low volume added service that can increase your margin. So when we start to look at, and this is the, I suppose, the fundamental economic driver. It's whatever you're doing, your rate multiplied by your volume. And it's one of the easiest metrics to calculate, and also doesn't really require a very complicated system to gather the information. But essentially, the resources that you have all go into producing whatever it is that you do, multiplied by whatever your average rate is. That's the key to pretty much every business. What I'd also like to talk about now is when you start to talk about rate and volume, if you can just picture in your mind, two plants or something, the rate and the volume have tentacles spreading out everywhere in your business. Everything influences rate and volume. For example, it can be as simple as, well, actually, when you go into a Coles supermarket, where's the milk? Where's the bread? It's right at the back of the store because they know it's a common item that people want to buy, but it's at the back of the store because they want you to pass everything else, hoping that they're going to get another sale so that they can increase their average sale. So all of those things come into play when we're trying to look at rate and volume. We've had circumstances where the changing of the employee's uniform increased the sales in the business. The way you set up your display stock will change the rate and volume within. So it's one of if you can measure your rate and volume, then these changes or other things that you do within your business, you'll be able to use the rate and volume as the yardstick to measure the success of what you're doing. So this is the example that we put together before. $300,000 worth of resources into our engine, so to speak, our rate and volume engine. We produced 400 widgets, $100 gross profit per widget, produced $400,000 worth of gross profit, $100 profit. So if we can find something or look within our business and say, okay, how can we increase the amount of product that we're selling, whether that's through some sort of offer, special offer, whether it's, would you like, like the Coles example of having their milk and bread at the back, they're looking to increase volume. anything to get people into your store, whole lot of range of things. But if you can come up with something that increases the volume of what it is that you're selling, then it just goes straight to your gross profit. Hasn't changed the resources that you put in, and you've generated a profit. We can then also go the other way and say, well, okay, I want to see if I can improve my rate. And that might be buying better. It might be talking with your salespeople and saying, well, we need to, if it's a negotiated price thing, it might be, we want to make sure that we're getting, $100 an hour instead of $95 an hour. We want to push our rate up. But whatever tweak you can do to improve your rate and volume will essentially flow to the bottom line. So, a classic one is clients. Sometimes people, I saw a recent example where, this manufacturing business had a very large multinational client. The business would normally do things at $80 an hour in their manufacturing process, but for this client, they were doing it for $50 an hour. As a consequence of that, this client was taking up close to 55% of their productive capacity. So what it meant was that by doing this job, yes, it felt secure and it felt good because you had this large company that you're doing work for, but they were actually eroding and destroying the average gross profit of the business. It just meant that, if the average was 80 and we're doing all of this work at $50 an hour, it just meant that all the other customers had to get charged out at something like $120 an hour in order to get them back to an even plateau of an average $80 an hour. So while some clients can look very attractive, they can actually have a bit of a sour taste to them. And again, everybody has their good customers. It's the old 80-20 rule. 80% of your good business or your profit comes from 20% of your clients. 20% of your profit comes from 80% of your clients. So you need to tweak that and say, well, how can I generate or how can I get more of these high profitable clients as opposed to getting more of the low profitable clients? And again, that's looking at your sale mix and again, focusing on the rate and volume as you go. Repeat business. You often see a lot of reward cards, loyalty cards. It's all about trying to get people to come back so that we can either increase our number of sales. So if we're, for example, a coffee shop, you should be counting customers, for example. How many sales did I have today? How many sales did I have yesterday? And they then form a trend, and you're looking and saying, well, what my average sale per day? And you're looking at ways to increase that average sales per day. So that might be the looking at a loyalty card. And getting back to that sort of tentacles running all through your business, take a coffee shop, for example. The little things that they do in their service while you're sitting at the coffee shop will impact on whether you're coming back or not. A good coffee shop, the moment you sit down, you'll have a bottle of water, and they'll ask you for a coffee order while you're choosing through the food menu. And pretty much a good coffee shop, as you've decided what you want to eat, the coffee's landed on your table, so that, well, the food's being prepared, you've got your first coffee, your food hits your table, you eat that, and then if they're good, they'll come back for another order of coffees. So all of that is a process where they're looking to increase the average sale, and they're also providing the customer service, which hopefully will change the volume, in that you will be a repeat customer. You'll come back, and that will increase the level of customers through their business. So Exceptional service will get repeat customers. Poor service, you'll lose customers. And that, whether it's a coffee shop, whether it's a service business, whatever it might be, poor service will drive customers away. Tradesmen are a very good example of where they can do little things that will get them referrals, that will get them repeat business, and the simple one is being clean. When they arrive at your home, they're not traipsing through your home with big muddy boots, and if they do make a mess, they clean it up. And so that just these little things put thoughts in the customer's mind as to whether, hey, that was a really good experience, I'm going to refer them to my friends, or and in these days of social media, which they might get on their Facebook and praise your services, but on the same token, they can also get on Facebook and impact your services by reflecting that you're providing poor service. So these sort of things will. It's looking at a holistic picture of your business, and all of these little things, all of these little tentacles, all come back to rate and volume. Okay. Third way in where we're looking at impacting on rate and volume is price. Just looking at that and saying, well, okay. Well, actually, I'll start by saying the most sensitive person when it comes to price is generally the business owner. And that's my experience about when we talk about business owners increasing price or changing their pricing structure. The most sensitive person about that is generally the business owner. So, for example, just as a very rough rule of thumb, most people don't notice a 4% increase in price. Anything under 4%, they don't generally notice, but that can make a dramatic increase in your turnover and hence your gross profit without essentially doing anything. Now these sort of things. You've heard me mention the one-page business plan. We also do what we call the power of one, which is where we look at exactly this rate and volume equation, and we talk about, well, if we can lift our price X%, what does that mean that we're going to improve in our turnover? And then we can also factor in there, well, if we do increase our price, do we expect our volume to decrease? So, for example, if you're selling widgets, we might increase the price up to, increase it by 10%. But we might see a 2 or 3% fall off in sales because some people who are price conscious or whatever have decided to not buy our product anymore. What we can do with that process is to measure and look at that impact to see, well, okay, what is the impact on the gross profit? What is the impact on the bottom line? And in a lot of cases, most of the time, it's, unless you're in a very, very, very price sensitive industry, you'll find that there's no real impact on volume, and you've just increased your average gross profit. Okay. Business processes. Again, we're coming back to this concept of thinking about the rate and volume with tentacles all the way back into your business. When we talk about processes, the way you do business, just quoting is a big area in itself. A lot of small businesses don't necessarily track their quoting. So how many quotes have I issued? How many quotes were successful? What's my success rate? And how can I change that? So if I can improve my success rate on my quotes, I will drive more volume. If I can, and it might come down to changing your letterhead, changing the way your quote is set out. That impacts on your success rate with quoting, changes the volume. So it can be that. It can be simply the way your receptionist answers the phone. It can be, as I've mentioned before, the way you present your products, the way you, even the way you package your product when you're sending it out to a client. And that goes for service providers and people who manufacture and sell goods. You know, if it rolls up in a tatty box and doesn't look particularly good, you know, if it comes much better presented, that can improve the volume. So, and then we also look at the way you manufacture as well. Are there things that you can do within the manufacturing processes? Are there things within your sales processes that you can improve? All of those business processes can either create extra sales or they can create extra margin through improving your rate. One way to look at your gross profit, which we haven't talked about a lot, is that cost of your sale or the cost of your material. Can you get a better deal? Can you negotiate a better deal with your supplier for your materials or for the product that you're buying? Is there a better way to source your product? Is there a better supplier? So the simple equation here is that if you can decrease the cost of your sales, you automatically increase your gross profit margin. Productivity is another area, and I sort of mentioned that before when we were talking about processes, but particularly if you're in a service industry, and for example, when you're selling hours or you're selling labor or something of that sort of process, productivity is critical. Whether you can get jobs, you know, for example, if you quote a job that's 100 hours, but through efficiencies and improvements in productivity, you're still quoted and charging on the 100 hours. But if you're able to get the work done in 95, 90 hours, then you've still got that. You've created that extra capacity in your business. It now means that you've got some extra volume in which to make more margin. So efficiencies, systems, process reviews, quality control, they all impact back to this rate and volume. So this is the critical thing. What you measure, you can manage. So if you're not measuring these basic metrics, you can't manage your business. Now, if I go into let's say if I went into a manufacturing business and they have no idea what their average gross profit or their hourly rate is or anything like that, one of the simplest processes we do is we just go back and we say, well, okay, at random, pull out, 6 to 10 invoices that you've done in the last 2 months. So we pull those out and we would have a look and say, well, okay, what's the material cost to do this job? And so from each invoice, we're then calculating the gross profit. Then whether it's a machine-based process, so in other words, we're talking about machine hours, or whether we're talking about workmen out in the factory floor spending labor hours on it, we then say, and again, if they don't have it, we try and get them to best estimate. We then try and say, well, okay, how many labor hours went into producing this job? And so we're developing a bit of an analysis on each job. So the sale price, the cost of the materials, hours to produce. Now from that, we're going to get essentially sales less the cost of materials. We've now got the gross profit, or essentially the labor component of the job. And for example, if that's $1,000 and they've spent 10 hours on the job, we've got an average labor rate here of $100. So that's the base information that we need to work with. Now, it could be that you're in a sales game. So it's more like, what did you sell the good for? what was the cost of the good? That's your cost for sale. If it's a service industry, again, you don't necessarily in a lot of service industries have a cost of goods. That's one of the peculiarities of a service industry. You might just have, this is what I invoiced, and this was my hour input into that to give you an average hourly rate. So from there, we can actually get an overview of their actual hourly rate or their actual gross profit per sale. And from that, we can then look and say, well, okay, let's compare that with what you desired to get. What was in your budget? What was in your, what were you hoping to turn over this year? And sort of map out and say, well, okay, this was my budgeted rate and volume. How does that compare with my actual? So you do need to do a bit of process into determining what your actual is versus what your desired or budgeted rate and volume are. Once you have those, you now have on your actual rate and volume, you have a yardstick to measure your business success. Now, what I generally try and promote when we look at or focus on this rate and volume is that I actually ask the business to, at the end of every week, to do that analysis. These are the invoices that this is my sales for the week. This is my materials for the week. This is my gross profit for the week. This is how many production hours I put into these jobs. There's my average hourly rate. So every week they're doing that. Every week they're looking at that average hourly rate, and we previously set up a budget or a desired hourly rate, and so we know how we're tracking. Every week we know how we're tracking, and every week that builds into a monthly rate, which builds into an quarterly rate, which builds into a half-yearly rate, which builds into a yearly rate. And every time we build numbers into this, we should be getting close to our desired rate. And one of the things that we can do with the rate and volume is we can measure changes. So if we do some significant change to our business, we can see what impact that has on our rate and volume. So it might be that you have a big sales promotion. You would expect to see your volume increase. You would expect to see, maybe you might not see your rate increase, but you'd expect to see your volume increase. And so you can gauge the response of different marketing concepts that you do, different marketing processes that you put in place. Is the newspaper ad producing more than the online marketing? Is the online marketing producing more than the sign out the front of the store? What is it that's actually producing? So just tweaking and changing things, and then looking back at your actual average rate and average margin, or whatever the measure is for your business, and seeing what the impacts are there. So it's a simple measure. It does take a little bit of time to set up and a little bit of time to understand it. But once you get that understanding, and again, you get into that rhythm of reporting it. And in my experience, the moment people identify and understand the rate and volume, and they start reporting it on a regular basis, we'll see improvement. Now, the question then comes down to who they're reporting to. And this is where your external financial advisor comes into it. If you've got it every week, write on a bit of paper or fill out a little form, shoot it off to someone. And again, it can be your accountant. It could be even a business colleague that you use as a mentor, that you're sending off this, and essentially you've now got a motivation to make this thing improve because you're reporting it. So these simple little things can significantly change your business. Now, what we do here is that we sort of combine that with looking at a process with what's important to you, so that we can, because again, it does come back to this strategic planning and understanding where you're going. It's all very well to create these tools and measure your performance, but you've always got to have that goal in mind. So we can look at the one-page business plan, which generates your budgeted targets. We can look at what we call a three-way forecast, which another way of talking about a three-way forecast is it's a three-way, or looking at this is what your desired results would be. This is your action plan for the next 12 months in regards to your profitability, your cash flow, and your budget position, or your balance sheet position. And it's key that we then do the review and the reporting. Who, what, when, and what. So you need to report, and you need to have some sort of accountability to make sure this rolls forward. And we do that through board of advice, quarterly board of advice meetings, where we can talk to people about how they've improved in their rate and volume over the past quarter, what they're going to do the next quarter to improve and change it. And again, it's the yardstick that we're using to measure how well we're heading towards our long-term goal. Look, I should have mentioned earlier, you have the capacity to shoot us any questions that you like in the control panel of the webinar there. So if you have any questions, feel free to shoot them through to us. We will be online for quite some time. We do have a complimentary report available. What we're going to be doing in the next day or so is shooting out an email just to do the what's important to you seminar. And you will be able to get some feedback as to that initial things in your business that are causing you grief, the things that stop you going to sleep at night, and then we can have a complimentary 1-hour session just to have a chat about those and what we can do for your business there. Again, as I said earlier, this is general advice, so if you're looking to implement any of the processes that we've talked about today, I suggest you talk to your accountant, or you can give us a call on that number there. Tomorrow we have a Managing Your Cash Flow breakfast. I'm reasonably sure that you can still enroll for that. But that's the third step in this series of seminars that we've been looking at. We looked at the one-page plan, the strategic plan. Today was just looking at the key metric, the economic driver of your business, and tomorrow we're looking at managing the cash flow growth for growth in your business. Here at Medoris, our primary why is to make the difference to your life so that you experience your lifestyle potential. And we do that with the wealth of experience that we have within our accounting staff, executive planners, and business advisors we have there. And there's a range of services which we help clients with. Thank you very much for attending today's webinar. I hope that you've got some useful information from today's discussion. And as I said, we'll be online for a little bit longer, and feel free to shoot through any questions that you would like answered. Thank you very much for your attendance, and wish you the best for the rest of the day. Thank you.